Now let's look at exercise 11. So exercise 11, we're accruing interest revenue and recording collection of a note. So here we've got on December 1, Cross Company accepted a 120-day 6% note for $4,000 in exchange for his accounts receivable. So we're just switching the receivable into a note because he can't pay us. So he's saying, can you give me more time? Let me sign a note and I'll pay you interest. All right. So on December 1 for that transaction, we're just going to record the note receivable, and we would identify that this is for Mr. Cross. And we'll get rid of the accounts receivable because now we're just turning it into a note. Okay, so that's the turn it into a note. Now, at the end of the year on December 31st, remember we're doing all those adjusting journal entries and updating our books. We need to accrue any revenue that we've earned and haven't received, or any interest expenses we've incurred and haven't paid yet. So we need to accrue those things. Well, in relation to this note receivable, we're earning interest that we haven't received yet. So here we're going to have to accrue the interest. We're going to record interest receivable because we're going to get it in the future, and we're going to record interest revenue for the interest that we've earned from when we signed this note on December 1 to December 31st. Okay, so let's come down here and calculate what our interest is. Remember, it's principal times the interest rate times the time. So here we're going to do, we're going to have the principal is $4,000. The interest rate is 6%. And how long have we had this note? Well, we signed it on December 1. Interest doesn't start accruing till the next day. So in December, we had it for only 30 days. So we're going to do 30 divided by 360. And that's going to give us our interest revenue that we've earned of $20. Okay? So we're going to record interest receivable and interest revenue of $20. Okay? Then we come down here, and on the maturity date, so let's calculate what the maturity date is. So it's a 120-day note. In December, we had it for 30 days. January, we have 31 days. So that would make 61 days. And then February, not including leap year, we have 28. So that brings us up to 89. March, we have 31 days. That brings us up to 120. Okay, so on maturity date is March 31st. We're going to collect the principal on this note up here. So we're going to collect the principal, and we're going to collect any interest. Well, we've already accrued interest here and recorded the revenue, so we know we're going to get rid of that note receivable, right? So let's go ahead and credit. We know we're going to get cash. Let's debit cash. And we know we're going to get rid of that note receivable. So let's write that note receivable of $4,000 off of our books. And we know we're going to collect this interest we've already accrued up here, that receivable. Okay, we're going to collect that interest that we recorded up there as a receivable. And we're also going to collect interest we've earned from January. Remember, we've already accrued up through December, January to March. So from January to March, we need to figure out what our interest is. Well, we're going to take our principal, $4,000, times the interest rate of 6%, times the rest of the time we've had the note from January to March. That would be 90 days. And that's going to give us our interest. And that's going to be $60. So this interest, okay, move it down. So this interest we didn't earn it before, we just earned it this period. So it's just going to be interest revenue. And we're going to go ahead and collect the cash this period. So we're going to collect that principal, the interest we've earned during our last period, so before December 31st, plus the portion we earned this period. So we're going to collect a total of $4,080. All right. I know sometimes this is a little complicated to understand. So if you have any questions, please post in that discussion board or send me an email. Okay.